back. About 10 minutes till the bell. It's time for the big picture. Joining us now from Charles Schwab is Joe Mazzola, the head trading and derivative strategist, as well as Collin Martin, director and fixed income strategist for the Schwab Center for Financial Research. You know, I was going to start with the equity market and go to Joe, but Collin, there's more fun right now in the Treasury market. So I'm going to start with you. We had a Fed meeting this week, and it's made no headlines. So talk to me about the Treasury market and what your assessment is of how we shaped up this week.
I'm just honored to get kind of first billing here as a bond guy. We're always in the back seat, so it's exciting to be in the driver's seat right now. You know, the Treasury markets have certainly calmed down a little bit. It was a bumpy ride in the beginning of the month. We had a pretty important Fed meeting this week, although we knew we weren't going to get too much out of it, knowing that there weren't updated projections. But I'd say that one thing we got from Fed Chair Powell in the meeting itself was, I think, a relative feeling of calm. Powell talked about the economy being relatively solid right now. That was a key point in the statement. And the idea that the Fed isn't in any type of rush to cut rates. I think that's where we're really at right now. And I think that's an appropriate stance. If we look at the actual data we're seeing, not the soft data is obviously very disappointing, but the actual data we're seeing, the economy's doing okay. That's how we felt coming into the year. The economy is growing above trend. Even if we look at that first quarter GDP report, if you strip out net exports, we're still, the underlying trend is still around 2.5 or 3%. So I think that's okay. And I think the markets, at least the Treasury markets, kind of breathed an air of a sigh of relief with that kind of patient approach. Expectations for the pace of rate hikes have been dialed back a little bit. As of now, the markets, the Fed Fund futures market, is pricing in less than 3 cuts by the end of this year. That's the lowest since before the tariff announcement. So I think that's really important right now. But now we're looking forward to the actual data to see how the tariffs play out to the real economy.
And I got some questions on that, but we'll come back. I want to get Joe's thoughts on equity markets. I just happened to realize this, Joe, in real time as I was looking at my platform. Exactly 1 month ago, on April 9th, the E-mini S&Ps had a 648.25 point range. Today, that range, unimaginably at that time, was 52 points. How do we reconcile how much volatility has collapsed in such a short amount of time?
Because fund guy Collin and the fund fixed income world, they've seen their volatility come down. I mean, I think there's a clear correlation, causation, if you will, that as the bond market has started to kind of settle in around that 4.25, to 4.35 or so on the 10-year, it's caused a little bit of stability within the equity markets. Now, that being said, I mean, there's definitely a macro focus, and all of this can change on a dime, especially with some of the talks coming out of this weekend. We'll see what happens with the talks with China, and all of this is stuff that's moving the market. But we've had a pretty decent earnings season, and I think a lot of that's priced into the market already. We've had some solid optimism around some of the macro data as that's been coming in, and macro can wear many names, right? It can be macro data in terms of some of the hard data that we've seen with unemployment, but it can also be some of the trade deals. I mean, I look at that as macro as well too. I mean, that is stuff that's moving the market. So as we're moving in the right direction there, I think you've seen some stability in the markets. Now let's just take a pause for a second and say, okay, well, we're talking about a trade deal with the UK that isn't really tremendously market moving, but at least it's setting the stage for something. And this morning, you got a little bit of volatility around, the 80% seems like a fair level for China tariffs. Well, we had heard initially that we were trying to get under 60%. So we'll see. I mean, like I said, there's going to be some volatility around those figures as they come out. But since we've seen the bond market at least find some decent footing, I think we've seen the equities hold as well too.
Yeah, so Collin, if we tie that together, obviously we've got inflation next week. You mentioned, hard data in focus. I'm going to throw trade policy, obviously, is going to be in focus as well. But when we look back at how a month ago played out, it really did seem like when things got a little bit squirrely in your world is when we saw a little bit of the administration crying uncle. Just they didn't admit it, but it just seemed to time up kind of nicely. So is there a bit of a Trump administration put perhaps in the treasuries from your perspective?
I don't know about the treasuries, but I think in the general risk asset world. So, I'll defer to Joe on stocks, but I think there's some sort of put as it relates to the credit markets, because we've seen credit spreads, both investment grade and high yield, come down pretty sharply. And if we were to get periods of, more volatility, or let's say we got, concerning news on the tariff front, we'd expect spreads to rise. But maybe the idea that they can always be rolled back again might put some sort of soft cap on how high credit spreads can go. On the Treasury market, maybe. I think it's something that obviously Trump and the administration is looking at very sharply, even though that Trump keeps talking about what Powell should or shouldn't do. They've made it very clear that they're focusing on different parts of the Treasury market. They're focusing on the 10-year Treasury yield. So it's back up to pretty much where it started pre-tariff. If it did start to creep up a little bit from here, especially on concerns about potential foreign selling, that could spook the administration a little bit to either to get something done or announce some good news. If we started to see Treasury yields rise sharply, I think that would be somewhat negative, just given all the fiscal concerns right now and how much it weighs on our ability to pay our debts, knowing that the debt is expected to continue growing. So I think they're going to be focusing a lot on that 10-year Treasury yield, around 4.25%, 4.3%. I think they're probably okay with that. If it started to creep higher, then they might start to get a little bit worried.
Yeah, and it just doesn't seem like a seriously, quick move to the upside, even though we got that a month ago. Is really baseline. It seems like that would be the big surprise move in treasuries, but maybe I'm wrong. Joe, I'll give you a chance. Final thoughts, equity markets to wrap up the week, or anywhere you want to go looking ahead to next week.
Sure. Well, let's just talk about the weekend, and let's talk about, at least getting started with the China trade talks. Why is it so important? 1.2 trillion in revenue from our companies selling to the Chinese consumers. I know we always think it's the other way around, but that number represents more than 4 times the size of the trade deficit that comes from Torsten Slok of Apollo. And the S&P 500 as a whole generates about 6.1% of its revenue from selling goods in China or to China consumers. So look, it behooves both countries to find some type of resolution. Hopefully, I don't think that's going to happen this weekend, but at least hopefully we're starting some make the legwork move in the right direction.
Yeah, and I think we, regardless of how big of the deal the deal with the UK was or not, it does seem that we have a roadmap now, maybe a blueprint for what these deals might look like and what we can look forward to perhaps down the line. China might be a little bit different beast, though. Thanks, guys. Hope you have a great weekend, and we'll catch up soon. That's Joe Mazzola and Collin Martin